Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. It's a new week. It's going to be a very busy one. Let's jump in. And we begin in North America. Canada's finance minister is promising a pivot toward, quote, fiscal discipline and long-term prosperity, end quote, as Ottawa prepares for a November 4th budget meant to spark private sector investment while maintaining credibility on deficits. Speaking to media on the sidelines of IMF and World Bank meetings in Washington in recent days, the finance minister said the government's new fiscal plan would seek to, quote, crowd in, end quote, private capital through major investments in infrastructure, housing and defence while reducing bureaucratic friction. Quote, this budget is about ensuring Canada remains competitive, end quote, he said, emphasising a shift towards capital formation under the Prime Minister's first fiscal blueprint. For many business leaders, the plan marks a potential turning point after a decade of investor unease under former Prime Minister Justin Trudeau's redistributive focus. The minister faces pressure from deficit hawks worried that spending will widen the shortfall without guaranteeing higher productivity. It is a risky bet. Economists surveyed by US-based Bloomberg expect the federal deficit to climb to roughly 70 billion Canadian dollars, 50 billion US dollars, or about 3% of GDP, while some analysts warn that it could approach 100 billion Canadian dollars. The finance minister declined to specify the trajectory of net debt, but said the government aims to balance its operating budget by 2028 or 2029 and gradually reduce the deficit to GDP ratio. He also pledged lower day-to-day expenditures to demonstrate fiscal prudence. The IMF, International Monetary Fund, recently identified Canada as one of the few G7 economies with so-called fiscal room to invest aggressively in productivity-enhancing projects. Still, Ottawa's mounting interest burden, already consuming more than 10% of revenues, has drawn sharp warnings from the interim parliamentary budget officer, who called the debt outlook, quote, not sustainable, end quote. Carney, the Prime Minister's team, argues that capital investment is essential to closing Canada's widening investment gap with the United States, where business formation has surged since 2015. Yet external shocks complicate the effort. US President Donald Trump's renewed trade tariffs have pressured Canada's manufacturing base, with Stellantis NV recently announcing plans to shift some production south of the border, a move the Canadian finance minister called regrettable. Meanwhile, the Bank of Canada sees only tepid momentum ahead. The Bank of Canada's governor described the economy as, quote, soft, end quote, noting that while Canada added 60,400 jobs in September, that gain only partially offset earlier losses. The unemployment rate has risen to 7.1% from 6.6% at the start of 2025, and the central bank expects a GDP growth of roughly 1% in the near term. Traders are now betting on a rate cut when policymakers meet later this month. Despite these headwinds, Canada's finance minister remains upbeat. He pointed to Canada's skilled labour force, clean energy potential, and vast reserves of critical minerals and rare earths as powerful attractions for global investors. Quote, Canada can be the supplier of choice to our allies and partners around the world, end quote, he said, arguing that a disciplined but ambitious fiscal push could finally unlock the country's long-stalled growth engine. Whether this is the right move or a huge mistake, which risks throwing Canada into the same fiscal crisis facing many other developed economies now, only time will tell. And speaking of developed economies facing fiscal crises, we now turn to Exhibit A. French high-net-worth individuals are moving record sums out of the country amid deepening political instability, with Luxembourg and Switzerland emerging as preferred havens. Wealth managers and lawyers say the outflow of private capital has accelerated since President Emmanuel Macron's surprise decision to call parliamentary elections in June of 2024. The snap vote fractured the National Assembly, producing successive fragile governments and a volatile policy environment that has unsettled investors. The trend has continued into 2025 under new prime ministers who have turned to higher taxes on top earners to address France's ballooning fiscal deficit. The majority of assets are now going into life insurance contracts in Luxembourg. Luxembourg's financial regulator reported a 58% jump in French investments in its life insurance products in 2024, reaching a record 13.8 billion euros. These contracts, similar to French annuities but offering greater geographic diversification, have become a favoured vehicle for those anxious about domestic political risk. Wealth advisors note that Switzerland is also benefiting. Swiss banks report renewed interest in securities holdings accounts and lump sum tax arrangements for new residents. Quote, For many, it's not only about taxes, it is about stability, end quote, said a Geneva-based lawyer speaking to UK-based Reuters. The exodus mirrors earlier episodes in British wealth migration after London ended favourable non-dom tax rules. Milan, Madrid and Lisbon have likewise drawn affluent newcomers, although Italy this week signalled plans to raise its flat tax regime for foreign residents by 50%. Analysts say moving funds abroad often precedes physical relocation. The contracts typically require a minimum investment of €250,000, offering what advisors describe as psychological advantages, even without major tax gains. While Macron once promised a pro-business France, his weakening position has dimmed hopes for market-friendly reform. With each new bout of political turbulence, with populist calls to tax the rich more French investors appear to be preparing an exit strategy, hedging their wealth abroad in case their confidence at home finally runs out. As France's fiscal crisis deepens, it risks alienating and chasing away the very part of the economy on which it most relies for its fiscal health. If you want to be on top of the most up-to-date analysis on the world's most important markets, consider subscribing to Market Update. Hit the bell notification icon and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. Next up, and finally for today, we move to Asia. Japan's political landscape is on the verge of a historic shift, with the Liberal Democratic Party, LDP, poised to form a coalition with the Japanese Innovation Party, Ishin, clearing the path for Sanai Takaichi to become Japan's first female prime minister. The alliance, expected to be unveiled 6 p.m. Monday evening local time, about an hour or so before this video is scheduled to be published, promises to reshape Japan's economic trajectory through a renewed emphasis on fiscal stimulus and industrial policy, though at the risk of rekindling inflationary pressures and market volatility. This is a space we've been following quite closely recently on Market Update. Financial markets reacted swiftly. The Nikkei 225 surged 3% to a record high, with the broader Topix up 2.1%, led by gains in electronics, defense and nuclear-related stocks. Investors are betting on what analysts have dubbed the Takaichi trade, a play on looser fiscal policy and a softer yen that boosts Japan's export-heavy stock market. Takaichi's economic stance echoes the late Shinzo Abe's Abenomics, aggressive government spending and monetary easing to fuel growth. Her criticism of the Bank of Japan's recent tightening signals a likely return to accommodative policy coordination. That stance, however, risks deepening the yen's slide, which has already boosted export competitiveness but driven up import costs, squeezing households with higher prices for food and energy. For Ishin, the coalition represents both opportunity and constraint. The Osaka-based Reformist Party secured commitments from the LDP to consider a temporary reduction in the sales tax on food, cut the number of parliamentary seats, and strengthen transparency on political donations. Yet Ishin's regional roots and populist reform agenda could clash with the LDP's entrenched fiscal conservatism and central bureaucratic control. The coalition's stability is far from guaranteed. With only 231 seats combined, too short of a majority, the bloc will need support from minor parties to pass budgets and legislation. Moreover, Ishin's limited national reach may strain coordination in future elections, especially in the Kansai region, where both parties compete for votes. Still, in the short term, the political shift has revived optimism among investors and business leaders. If Takaichi delivers on promises to stimulate growth through infrastructure, defense and energy revitalization, Japan could see its most expansionary policy mix in a decade, one that might boost confidence but test the country's fragile balance between growth and inflation, and of course put more fiscal pressure on one of the world's most indebted developed economies. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I hope to see you for another episode tomorrow.